LD build some serious wealth with just a few clever, seriously low-effort moves? Imagine an income stream that pays you while you sleep. No staring at blinking charts, no dealing with nightmare tenants. Sounds a little too good to be true, doesn't it? What if you could build some serious wealth with just a few clever, seriously low-effort moves? Imagine an income stream that pays you while you sleep. No staring at blinking charts, no dealing with nightmare tenants. Sounds a little too good to be true, doesn't it? Well, today we're breaking down the laziest and smartest dividend strategies out there. We're going to redefine lazy investing and turn it into a money-making machine that works for you, so you don't have to. The lazy philosophy, why this works. Let's be honest, the whole world of investing can feel like a massive headache. You hear about day traders making and losing fortunes in the same afternoon and see headlines about strategies so complex you'd need a PhD to understand them. It's not just unappealing, it's intimidating. And it's why most people just don't start. But what if the best way to build wealth wasn't the most complicated? What if it was actually simple? That's the entire idea behind the lazy investor philosophy. This isn't about being careless. It's about being incredibly efficient. It's about setting up a proven, automated system and then getting out of the way. And the secret weapon in our lazy arsenal is the dividend. For anyone new here, a dividend is just a slice of a company's profit that it shares with its stockholders. Think of it as a cash thank you for owning a piece of the business. You get paid just for holding on. Now, when you take those payments and automatically use them to buy more shares, through something called a dividend reinvestment plan, or DRIP, that's when the magic happens. It's called compounding. Each new share you buy starts paying its own dividends, which then buys you even more shares, and on it goes. You've just started a wealth snowball that grows bigger and faster all on its own, without you lifting a finger. This isn't a get-rich-quick scheme. It's a get-rich-slowly but surely machine, and it's the perfect foundation for a lazy portfolio. So, where do we start? Let's get into our first, and arguably laziest, strategy of them all. Strategy number 1: the automated approach. Dividend ETFs. If you want the ultimate, set it and forget it, investment, say hello to the dividend ETF. An ETF, or exchange-traded fund, is like a pre-made meal kit for investing. Instead of researching and buying dozens of individual stocks yourself, you buy one share of a dividend ETF and, bam, you instantly own a diverse portfolio of top-tier, dividend-paying companies. This is peak laziness, because you're letting the pros who manage the fund do all the hard work for you. One of the most popular all-stars for lazy dividend investors is the Schwab US Dividend Equity ETF, ticker symbol SCHD. SCHD is designed to track 100 U.S. companies that have a rock-solid history of paying dividends, focusing on financial strength and overall quality. By buying just this one thing, you get exposure to a powerhouse lineup across different industries. We're talking giants like Chevron, the Home Depot, and PepsiCo. Now, the exact lineup can shift, but the fund's goal is always to hold high-quality companies. The fund is also famous for its ridiculously low expense ratio, which just means more of your money stays in your pocket, working for you. The beauty of an ETF like SCHD is that it perfectly balances two key goals: income now and income growth for later. It gives you a healthy mix of companies, providing a steady dividend paycheck today with the potential for that check to get bigger in the future. For the lazy investor, it's a dream. You make one purchase, set up automatic reinvestments, and then you can just walk away. The dividends get paid, they get reinvested, and your wealth machine just keeps humming in the background. Strategy number 2: the classic lazy move, the dogs of the Dow. Alright, what if you want a strategy that's a little more hands-on but still requires basically zero research? Let me introduce you to a classic, the dogs of the Dow. It's been around for decades, and its beauty is in its simplicity. The Dow is the Dow Jones Industrial Average, a group of 30 of the largest, most influential companies in America. Think household names like Coca-Cola, Johnson & Johnson, and McDonald's. These are the blue-chip titans. Here's how the dogs of the Dow strategy works in 3 dead simple steps. Step 1. On the first day of the year, you look at the 30 stocks in the Dow and find the 10 with the highest dividend yield. A high yield often means a great company's stock is temporarily unloved or undervalued by the market. Step 2. You buy those 10 stocks, putting an equal amount of money into each one. Step 3. You hold them for exactly 1 year. Don't touch them. Don't worry about the daily drama. You just let them sit. At the end of the year, you do it all over again. Sell the ones that have dropped off the top 10 list and buy the new dogs. So, why does this work? It's a clever form of value investing in disguise. The formula systematically makes you buy large, stable companies when their stock price is low compared to their dividend. You're automatically buying what's on sale and selling it a year later after it, hopefully, recovers, all while collecting some nice dividends along the way. It's disciplined, unemotional, and wonderfully lazy. You only have to think about your portfolio for one day a year. The rest of the time, you can get back to doing, well, whatever it is you love to do. Building your lazy portfolio, a balanced diet. Whether you go with the ultra-lazy ETF or the once-a-year dogs strategy, there's one principle that makes any portfolio stronger: diversification. But I'm not just talking about owning a bunch of different stocks. I'm talking about a balanced diet of sectors. Think about it. You wouldn't just eat carbs, right? You need protein, fats, and vitamins to be healthy. Your portfolio is the exact same. Putting all your money in one sector, like tech, can be a recipe for a stomachache. But spreading it across different industries gives you stability. Different sectors shine in different economic climates. Let's look at a few key ones. Utilities. Think about the bills you pay every single month: your power, your water. These companies are dividend machines because people need to keep the lights on, no matter what. Consumer staples. These are the companies that sell things we buy over and over without thinking, like soda, toothpaste, and snacks. Think Procter & Gamble or Coca-Cola. Their sales are steady, and their dividends are famously reliable. Healthcare. From life-saving drugs to medical devices, this sector offers a fantastic mix of stability and growth, with a strong track record of increasing dividends year after year. Financials. This includes banks and insurance companies. While they can be more sensitive to the economy, they often offer very attractive dividends, especially through specialized funds like REITs, which focus on real estate. Technology. Once known purely for growth, more and more tech titans are now paying out solid dividends and, better yet, growing them fast. By owning a mix of these, you build a portfolio that can weather almost any storm. If the tech sector has a terrible year, your boring but beautiful utility dividends help cushion the blow. An ETF like SCHD already does this for you, spreading its investments across sectors like healthcare, financials, and consumer goods. This balanced approach is the final touch on a truly tough, lazy portfolio. An advanced lazy move, and a warning. As you explore dividend investing, you might stumble upon a strategy called dividend capture. On the surface, it sounds like the ultimate hack. The idea is to buy a stock right before it pays its dividend, capture the payment, and then immediately sell the stock for a quick profit. What's not to love? Well, a lot, actually. Here's your friendly warning: dividend capture is fool's gold. And for a lazy investor, it's not lazy at all. It's a high-risk, high-effort trading tactic that usually backfires. Here's why. When a company pays a dividend, its stock price typically drops by an amount that's roughly equal to that dividend. So, if you capture a $1 dividend, the stock price is likely to fall by about $1. Your net gain? A big fat zero. In fact, once you factor in trading fees for buying and selling, plus taxes on the dividend, you often end up losing money, and that's the best case scenario. If the market is shaky and the stock drops even more than the dividend amount, you're stuck. You either sell for a loss or have to hold on and pray for a recovery, which totally defeats the quick profit idea. The true lazy investor isn't playing these short-term, high-stress games. We're in it for the long haul, building real, sustainable wealth. So, if you hear someone bragging about dividend capturing, you can just smile, nod, and know your simple, effective, and truly lazy strategy is the much smarter path. So there you have it. Building a dividend-powered money machine doesn't require a finance degree or being chained to your computer. All it takes is a little upfront setup and a commitment to being productively lazy. Let's recap the game plan. For maximum laziness, use a low-cost dividend ETF like SCHD. Buy it, reinvest everything, and let compounding do its thing for years. For a hands-on approach, once a year, the Dogs of the Dow is a simple formula to buy great companies when they're on sale. For all weather strength, no matter your path, make sure you have a balanced diet of different sectors to keep your income stream safe and sound. By following these simple rules, you can create an automated income stream that grows over time, paying you to do all the things you'd rather be doing than worrying about the stock market. If you found this guide to lazy investing helpful and want more simple strategies to build your wealth, do us a favor and hit that subscribe button and ring the notification bell so you don't miss what's next. And as always, please remember this video is for educational purposes only and not financial advice. Always do your own research before making any investment decisions. Thanks for watching, and happy lazy investing.